Agent-based modeling is the idea of modeling systems by creating virtual humans. If you think about it from a personification from a trader perspective, they're like virtual traders. One of the hard things is, how do you make these agents realistic? How do you make them human? These are great and amazing tools, but at the end of the day, still under a lot of legal regulations globally, a human has to make a decision.
Welcome to the Alpha Intelligence Podcast. My name is Matt Robinson. I'm joined with my co-host, Francesco Fabozzi. And we're very happy to have Alicia Vidler here with us. As we were getting started, we were talking about your background and bridging these sort of two worlds, right?
Certainly. So firstly, thank you guys for having me on today. So I think the interesting thing about the evolution is we've seen this a few times before. I joined equity markets and trading in 2000. And we'd just seen a big sort of burst of activity in certain markets, electronification. And over those years, we've seen the rise and sort of demise, but like the less focus on certain technical aspects. We saw lots of physicists come into the marketplace and equities in the sort of mid-2000s, and that has evolved and changed. I think one of the more interesting things that I find throughout my history is just the patterns that cycle through. We start with an adoption of technology, or perhaps markets developing systematic processes. Systematic trading really began in the late 90s and late 2000s, sometimes just to even deal with the fact that parts of the world left orders for other parts of the world, and there had to be some sort of process around it. How do you deal with my order if the order's been put in overnight? And I think what we're seeing nowadays is the amount of technological knowledge necessary, that hurdle rate to get into certain trading areas is really high, that you can't expect everybody to have everything. And so you have groups of people who have really deep technical knowledge, but a classic example of the hard sciences, which have certain assumptions like negative numbers don't exist, where those of us like myself have been around long enough, I traded negative rates for quite some time. And these are really interesting. People like to call them edge cases, and they are edge cases until they turn up each and every week, like we're finding in certain markets at the moment. And I think it really does speak to the fact that some markets have evolved and other markets have changed the way they do things, but not necessarily more electronically.
We've seen with the treasury market. How do you see these topics impacting the recent moves?
The phrase, the road to hell is paved with good intentions, can apply to market regulation or market design and features. We look at government bond markets, which is something that has been near and dear to my heart in a research capacity for the last couple of years. We've seen lots of attempts, lots of really well-meaning, lots of good attempts to make markets more robust, more resilient, to make sure they can trade well and they can trade through crises. But yet we've seen huge amounts of government issuance. The US, I think, is sitting at correct me if I'm wrong here, $40 trillion of government debt. It's doubling every 10 years or so. And yet the number of market makers in those sorts of markets haven't meaningfully changed. And the way in which those markets actually function in the UK goes back literally centuries to when the Bank of England was set up. On one hand, we're evolving and we're putting computers in place and we're trading things faster and quicker. On the other hand, some of the underpinnings, some of the structural underpinnings, I heard a quote last week that NASDAQ at one point had 5 billion messages going through their systems in a given day for the last couple of weeks. And they handled that really well. And yet bond markets in many parts of the world, many developed parts of the world, Australia, etc., which are all affected by what's going on in the treasury market for various reasons, actually have 20 market makers that are the central component. And we have this sort of fast and slow mixing together. And that always creates challenges. That always creates challenges.
I looked at some of your research papers and looking at like your agent-based modeling. And is that what you're doing for your research? Could you actually explain for the audience what agent-based modeling is and why it's relevant in these situations?
It's a really great question. I'll take it in two parts. Agent-based modeling is the idea of modeling systems by creating virtual humans. If you think about it from a personification from a trader perspective, they're like virtual traders. The pure computing science side of the world would think of them slightly differently, but I think for our purposes, we can think of them like virtual traders. And you can model human interactions. You can model a marketplace, which is, at the end of the day, a bunch of risk managers or traders or portfolio managers or owners of assets engaging. And you can model them as virtual agents, having those engagements between each other. And you can literally play out what those behaviors might look like and give each agent a set of rules or a set of features. Those rules might be, when my risk goes up, I sell X bonds, or when I get to the end of the day, I want to be flat. You can have a whole bunch of trading rules, and you can describe how those agents all relate to each other. For example, a client must trade through a bank if they're in a regulated market maker environment. So agent-based modeling is just this idea of you can literally play out how agents interact at a very minute, granular level. And it goes back to the 1970s and 80s. And it comes from a way of trying to mimic social engagements and interactions. One of the hard things about agent-based modeling is, firstly, it takes into computational processing, because you've got 4 or 5 agents, it's one thing. But if you've got 1,500 bondholders, which is roughly the number of holders in the UK bond market, for example, that's a lot of interactions to model, and there's a lot of things you need to take into account. But that these days is pretty much well solved because of our chip development. But one of the hard things is, how do you make these agents realistic? How do you make them human? And no, and Francesca, you know better than most of us, that it's actually hard to assume that all traders and all humans are rational and that they're going to behave in a rules-based way. In fact, there's lots of academic and just life experience in the markets that says people aren't always rational. So there's this great idea of using agent-based modeling, or agents, which are autonomous by definition, with agency, the ability to do something, make a choice, even if that choice is to buy, sell, or to do nothing, and to give them some sort of human aspects. And this is where LLMs come in, and they're beautiful for this. The idea that LLMs, as we all know, stand for large language models, and they're trained on the corpus of human text, which is supposed to represent humanity. And that's where the idea begins. On the top of that comes this idea of, okay, if they're trained on humanity, are they actually like humans? Are they good enough? Can they represent us? And this is a huge can of worms. It's a huge can of worms because, A, there's some technical challenges. And we've all seen those memes online about, show me what a US High Court federal court judge looks like, and they show you someone who's white and male and about 65 because that's what they've been trained on. But at the same time, there's a lot of research that says actually they embody historical norms, so they are a bit like humans, as imperfect as humans are. And the reality is there's a lot of technical challenges in actually mixing agent models. So there's a couple of problems. And the first one I would call just like engineering plumbing. How do you get 2 LLMs to talk to each other? If you're trying to create a bubble and you're trying to create 2 to engage with each other, the actual process of getting 2 models to engage with each other is actually quite clunky and quite tricky. There are some nice tools out there. I won't name drop what they are, but there are some nice methods of doing that. But it's a little bit like asking 2 junior traders with no background to trade with each other. How do they learn? What do you tell them? What rules do you give them? And so then the next thing becomes, okay, large language models have been trained on the human text, online, offline, bookcases of books, etc. What's mostly in those books? There's not a lot of adversarial negotiation going on in those books. There's probably not a lot of decision making. The average book that you open up on a bookshelf doesn't have a lot of even yes or no's in it. It has a lot of analysis. So these models don't come from a place of decision making, and they don't come from a place of actually conversing with each other. So then the question becomes, how good are they at being rational or irrational? And there's a lot of work around it. And the short answer is not very good. And the longer answer is you can make them better or worse by layering techniques on top of them. But this is still really cutting edge research, and it's thing that's being published quite literally in the last month or 2.
When I did agent-based modeling in like coursework, you would get a problem when you would describe what the noise traders do, what the like irrational traders are doing. And then you describe what sort of different market participants do. But then at the end of the day, it turned into functions that you were basically mixing together to form your market and the environment. So now, how do LLMs compare to that sort of previous era of, and I assume you're doing a lot of prompting in order to make an agent behave like a certain market participant?
So the interesting aspect is what you're describing with the agent-based modeling you're talking about now, is what is actually developed into sort of multi-agent reinforcement learning. In the FX markets, actually, it's quite big. Because the nice thing about the FX markets is market participants tend to fall into two lovely categories. They're either liquidity providers or liquidity takers. And so this categorization into two homogenous groups, i.e. two groups that are really similar, because in the FX world, people are systematically either one or the other, produces really easy models. What you're actually talking about is, can LLMs make the models more realistic and more interesting and more diverse and homogenous and more heterogeneous? And they can. The prompting side is really tricky. Every single model version and subversion of the larger, more foundational models are developing so quickly and so rapidly that every single solitary new trained version, which can come out every week or two or three, can behave really differently. And your prompting is very specific to the specific model built around. Personally, if I can share what I do, I try and make the LLM responsible for the most basic of decisions, simplified of decisions. But I do think we're at a point where we will soon be able to see ways, and there is academic work around trying to get two LLMs to negotiate. You can imagine a world where you have each bank or each client has their own virtual negotiator that's like a superhuman negotiator. These things are in the works and are definitely coming along.
Maybe you could take a step back because, as you said, this is like cutting edge stuff. How far away are we from seeing this? Is this going to be what like a limit order is today? If this stock goes down to this price, I want you to buy it.
Yeah. So I think it really depends on which market you're talking. So one of the other things I've observed as a trader over the years in a variety of different markets is that, unlike lots of other areas of technology, not all markets have become more technological. There are, the equity markets have technologies even 15, 18, 20 years ago that don't exist in lots of other large developed markets. And you've got to remember for your audience, what is the size of the global equity market compared to the whole world's capital markets? Depending on how you look at it, it's 15 to 30%. The remainder, that sort of 70 to 85%, depending on how you slice and dice it and look at it, in many ways, even private credit, which has just ballooned over the last couple of years, these markets, they don't trade on exchanges. There is no limit order book. And so actually, I think we're seeing this bifurcation in finance to super liquid, transparent, high amounts of retail investors in the equity world. And then we've got this other part of the world, I don't know any retail investors that can access private credit directly. And those markets, there's almost not an infrastructure to have the technology match you talked about. In equities, there is, absolutely.
Right.
Fixed income, yes, no, depending on how you look at it and how you think about systematic internalizers. Bond markets are different and country specific.
I think up until a couple of years ago, like CLO market still settled with faxes.
Yeah.
So,
Yeah. Absolutely.
Do you see an advantage for funds taking advantage of the tech, applying some of these sorts of strategies? Just curious if you had any thoughts there.
Yeah, I definitely see this as a huge opportunity because whilst fixed income has actually not become more electronic, what has happened is regulators, Bank of England, Bank of Canada, Reserve Bank of Australia, the Federal Reserve of New York in particular, are on record as basically saying you have to put in place some of these mechanisms, which start with a central clearinghouse. That old technology we might remember from second year economics classes, market classes, like what is the point of a central clearinghouse? It turns out it's like the central hub of a hub and spoke mechanism, which is the financial market. And in fixed income and a lot of government bonds, these clearing mechanisms don't exist, and they become the foundation on which you then put exchanges, which then allow this transparency. And more regulators, more and more market oversight facilities globally are on public record saying, we need these for good stability. We need them to make sure that our funds can actually transpire. There are enough dollars in the system. that can be accessed when necessary.
Maybe not treasuries or government bonds, but thinking of just corporate bonds or even private
Yep.
debt. You think LLMs are changing that? Because it seems these are markets that are highly driven on like legal documentation and these
Yeah.
covenants and ventures. So that's where I really think LLMs are actually providing a huge opportunity. I don't know so many use cases. Maybe they're just like internal at banks. But if you think of anything of how LLMs might be able to change that.
The average deal indenture I used to have to read, and I did actually read them because I did care, was buried into them. And I often ended up dealing with CDOs or CLOs and a lot of corporate bonds that were fallen angels. So you really start to care about what's buried in the 300-page deal indenture document. 300 pages of dense legal matters that one or two sentences can make the difference between the ability to restructure the company and to rescue the debt, which may or may not be senior, subordinate, all these terms to do with where you sit in the capital structure and what your ability to affect value from that trade is, are buried in 300 pages. And so that's per bond. Now, the massive increase in private credit means you've got bespoke documentation. Private credit, by definition, is bespoke. Everyone is slightly different. Corporate bonds, at least, tend to have standards, and there are international organizations for these standards. And so LLMs offer a great opportunity at scale to parse large amount of documents. However, I don't know if any of us have recently tried to put in a 300-page document into an LLM. I actually have. I mentioned I recently submitted my thesis, and all good doctorate students, I was terrified of spelling errors, and I wanted to check my whole document. It's still really hard to get what's called the context window of LLMs to take in that much information. There are ways, there are private versions, there are methods of doing this, but it's actually still quite heavy lifting to look at the whole document. So there were businesses in the past, which I won't name, that made entire corporations based on parsing and tried to reduce down these documents into XML, if you remember that language, and a few other things. The documentation within private credit across the globe, including real estate, VC funds, is something that just about everybody I know in that world is desperately trying to solve with an LLM. And I think there's great hope. But there are still actually engineering challenges.
Because I've done that too. You try to, maybe one of your papers, I load it up and I'm like, okay, explain this to me like I'm 5. And if it's too big of a file, like it breaks.
Can't do it. Yeah.
I joke that now you don't have to be Michael Burry from The Big Short, right? You're probably not going to be as good as him, but you could apply some of that technology. What would you do? You have to chunk it, I guess, some of the text, or?
It's a really good question, because I also used to go through the spreadsheets and look at loan default rates of my underlying mortgage-backed securities at the time. And so some of the challenges are really similar. Like, one of the problems at the time when you actually looked at those spreadsheets were that they used to just cap out on Excel memory. And that's a similar thing we're seeing with LLMs. Like, they have a context window. Those of us listening who don't know what that is, just basically, what is the amount of memory you can dedicate and take information in and pull it apart? One way to do that is, as you said, to chunk up a document. What you then lose is how the relationship works in the document. And this is really important with legal documents, because this clause relates to that clause A relates to clause B, and it might be overridden by clause C. So that's quite tricky. But these are problems that are being solved, and there's various commercial solutions. Where I think the Michael Burry example is really interesting is he asked questions that many other people weren't so concerned about. I know from the movie, there's that famous scene of him like going through hundreds of lines of spreadsheets. You could also just sum up columns and look at averages. So I think there are always ways to deal with large amounts of information. But what LLMs don't do is they don't ask good questions. And that's something they're not designed to ask questions. And I think that's the part where humans will always have an advantage. But undeniably, if you're dealing with a CLO portfolio, which by definition has 100 loans in it, your ability to query 100 documents quickly is definitely improving. I don't think it's there yet. I don't think the analysts of the world have too much to worry about just quite yet. There is this absolute use case around documentation in this part of the world, absolutely.
I think you made a really interesting point, because I've tried to do some toy examples of, oh, let me just go through like chunk by chunk, looking at different covenants, and it doesn't really do a good job of pointing out these really bespoke covenants in certain, and because they relate to one another. So that's why like a traditional this chunking approach wouldn't work. So I guess that's where I think there are opportunities for that. Everyone's trying to build a equity sort of trading assistant or equity chat assistant. And it's really the best technologists will survive there, or whoever can build the best tech. Whereas with fixed income, there's so much, it's so esoteric that just a standard computer scientist can't come in and know the questions to ask how these indentures work. So that's very interesting. And my question there is, you don't think that any sort of RAG approaches of finding, like any sort of RAG approaches, they won't be able to find that sort of connection? And by RAG, these like retrieving the correct information as opposed to just chunking.
Sorry, just, and like RAG, the way I think about it is this: you're basically like uploading a document to an LLM, right? Like you're like giving it, hey, I want you to focus on this text. Is that the right way to think about it?
There's large language models that generate text, and there's large language models that will vectorize text. So it turns it into a row in an Excel file. And there's certain mathematical techniques that you look at, like cosine similarity. So if I ask a question to a RAG and it has all of the text in an Excel file, it can figure out what chunk of text actually most relates to that, extract that part, turn it back into textual form, and then use that as context within the answer. So it's getting around some context windows. But yeah, sorry, Alicia.
Yeah, no, it's a really great, and it is a great explanation. I think what you're talking about is specialization.
Mm.
And this is, and to go back to my earlier point about seeing patterns and recurring syntheses, recurring features, this is how CLO managers began. They had the humans who are really good at knowing what parts of dealing data to look at so they could look at many very quickly. And we're building LLMs at the end of the day in a similar fashion, this specialization. And yep, I think we'll definitely, I'm sure there's some firms out there that have built CLO Manager 2.0, which is a fine-tuned LLM with great RAGs based on specific North American deal indentures. I can see the use case already now. And I think the question becomes, when the next issue, and this is something that isn't talked about very often, but from a technical or academic standpoint, really worries people, is the explainability and how do you know how to check your LLM? Because all the usual methods we're used to in finance from model verification don't really apply in the same way. And this is something where if I was a manager of a CLO again, or I was trying to work out how to price something, I'd feel pretty uncomfortable understanding, how do I know the information I'm looking at is directly related to the document? Can it literally tell me what page that piece of information came from? And then the other big piece of the puzzle that is still a work in progress are LLMs dealing with numbers. And a lot of these diligences do have covenant restrictions. Sometimes they're written in words, but at the end of the day, they're numbers. And this is something that is still, if I would put it this way, a little bit unreliable from the LLM world. For your listeners, the nice thing about large language models is language is pattern-based. We say, good morning. We say, hi there. That we have lots and lots of patterns, cosine similarities, as you put it in mathematic terms. Numbers two does not necessarily always follow the number 3 in the same way with a high probability, etc. So this is where the world of finance, which is still very numeric in many ways, but covenants are still numeric tests, can struggle, and it's still a bit of an open question how best to protect against that.
Interesting you were saying about specialized, because I remember each of my different beats when I was at Bloomberg, like I used to read, oddly enough, structured notes, prospectuses. And at first it was 100 pages, but by the end you were like, okay, I knew the 5 places I need to go. And it's like starting to see that maybe with, if you were to take that human and then train the machine to be like, okay, this is where the good stuff is.
So that is very true in markets that are somewhat more cleared, because the thing about clearing, to go back to my earlier point about market structure, the thing about clearing or clearing houses, they tend to have rules and documentation. You tend to have some standardization. You tend to have, whether it's an ISDA, a standard, etc. And yeah, the really important features are in very specific locations within the documentation. And there's a pattern and a formula that certain parts of the document relate to very specific things. And you always know something to do with a covenant is in section 3.4, etc. So you always know to look in 3.4. It's nowhere else in the document. And so the less that is cleared or the less that is going through a clearing house, the less you can actually rely that the document is standardized. That's one of those things where it's on a path to more transparency and more computer interaction, are more standardized markets.
I was wondering, you've worked on a lot of different trading desks, and more interest is coming on this topic. And everyone's, oh, it's going to take people's jobs, or what does this mean? And it's something I'm always wrestling with. And I'm sure you've maybe had some old colleagues call you that they know you do this.
Yep.
And then what does this mean for me? Maybe not today, but like a year from now, 3 years from now, what should I try to do? What are the practical implications to the investor world today and the years to come?
Yeah, I get a lot of those questions, actually. I get a lot of will the market be to say yes in many ways? I think the short answer is everything will change, nothing will change. And by that, these are great and amazing tools. But at the end of the day, still under a lot of legal regulations globally, a human has to make a decision and a human is liable for it. Regardless of whether the order goes through a computer, and it's the same with a lot of equity markets, a computer cannot be held legally liable for manipulating the market. A human is ultimately held legally liable. So no matter what happens, the buck stops with us humans. And so humans are still in the loop by legal requirement and definition in just about every place I can possibly think of. So humans are not going anywhere, number one. Number two, there's a book that as a young trader I was told I had to read, and it's called Reminiscence of a Stock Operator. Now, I think everyone on this call may have read it. Anyone else who hasn't, you should go and look at it. It's about a high-frequency trader in 1904. Now, and this is a book written about someone's experiences in the New York Stock Exchange in great detail about reading the tape from the exchange and different trading patterns and ways to interpret it. And it's basically the high-frequency trading of their day. It is remarkably similar to high-frequency trading in equity markets even today. Yes, the technology is very different, but the mechanisms and behaviors, the way in which liquidity moves through the marketplace, the human element, the panic, the fear, the bubble, the etc., are still all prevalent and all present, actually. So I think there's a lot of fear because it's really unknown. And this level of technology, especially LLMs, are becoming more technologically advanced so a lot of people are comfortable with. But I don't know that this is that dissimilar to the 1980s when lots of people had to start using computers when they'd previously been writing tickets. My first job at Deutsche Bank, I still had to write tickets in triplicate to book things into a system. And so I don't know that it's actually that different to all the other technological advances that have come along, but undoubtedly the speed with which things occur has definitely increased. That's undeniable. I also still think there's a huge place for decision making because LLMs, as any researcher, try to get two LLMs to make a decision, to buy and sell something, to have lunch, not have lunch, even basic things like what sort of coffee do you want? It's incredibly hard to make a decision. And most of these software that we're all talking about fall into the category of what's called decision support, technically speaking. How do I support your decision? How do I boost your understanding of the markets and be a great chatbot and recommend 5 stocks that you investors will have to pick the best one you want to invest in?
That's exactly how I feel. It's all of this like trading support and not decision making. They're making only a decision as to what information to present, the most relevant information to present. But whether or not you want it to try to make decisions is a totally different aspect. And that's why I think that a lot of discretionary traders are the ones that benefit a lot from this, because you, instead of having a junior analyst and you have to wait till the next day or a week to get some sort of analysis that you want, you can be a PM and just chat with a bot all day.
Absolutely.
Yeah.
And thinking of them like a junior analyst, I think is a really good way of thinking. I have friends in the legal fraternity that will think about LLMs as the first draft variant, or they're like junior paralegal. And the LLMs don't have great context. They make silly mistakes. A great example is someone asked their junior to help write a board pack for a board meeting, and they came back with 70 slides. Now, anyone who's ever attended a board meeting knows no one at a board meeting looks at 70 slides. But the junior didn't know that and wasn't informed of that and couldn't possibly have learned that at an excellent university or otherwise. And I think this is exactly the right way to use the technology at this point in time.
In terms of, so I'm sure you've been on the technical side of outside of LLMs, and you do work in like machine learning and this AI. Now, in terms of what you do, maybe you can't speak super specifically about what you're doing, but how do you see other use cases of LLMs that people aren't really seeing, or you're just trying to work towards making them more beneficial for traders? And yeah, so non-decision support, but more on the side of how they can be used in a systematic way.
So one of the things that I'm currently doing quite a bit of work on that I can speak to is the idea of what is underlying the information they are presenting. And I don't mean the words, the randomness or non-randomness, or the distributions that underlie their behaviors. As models get more and more complicated, and this is not just LLMs, this is any computer model, even our desktop computers that we're looking at, as they get more and more complicated, we start to forget they've got some really fundamental componentry that's really important. With a computer, how many of us used to know I had an i4, I had an i5, I had this, I had that, I have a 386 or 486, etc. Now I had a Pentium, etc. Nowadays, we just go buy a desktop computer. But we used to really care about the hardware and the processing speed because it was the unique descriptor for how good our computer was or how fast it was. With LLMs, we've all really, frankly, fallen madly in love with how useful they can be on a day-to-day basis, doing everything, not just even in finance, just spell checking, researching, crafting words, writing the ultimate birthday card poem for the family get-together. Name the use case there with an LLM. We've forgotten they're still made up of some really fundamental componentry. And a lot of the use cases will end up tapping into that fundamental componentry. And work that I've been doing recently that I think is definitely something that a lot of people are starting to look at is, what is the distribution? Can an LM, for example, understand a normal distribution? Now, this is really important in finance because, as we know, so much of finance, when it comes to pricing, options, Black-Scholes is absolutely ubiquitous within options world. Those of the listeners who don't know what Black-Scholes are, it's an options pricing formula, and it relies on normal or log normal distribution, depending on how it's set, which particular version we're using. If you want to use an LLM anywhere near the options world, at some point it's going to have to understand how to create what is a log normal distribution or a normal distribution, and how to sample it, which is to take a number from that distribution that is representative within that distribution. Turns out LLMs are not built like this. They're not built for this, and they can have some really dramatically different results. Your favorite public large foundational model that shall remain nameless, pick 2 subversions, test this feature, test it in 2 or 3 different ways, you will get very different results. And this is the underlying infrastructure that goes into wherever these LLMs then go. And so that's what I've been spending more and more of my time on, because that is a potential weak spot that won't go away just by having a better rack or having better fine tuning. It won't go away. It's potentially an underlying structural component of this technology. That machine learning is very different. Machine learning is completely different. This is not.
You were talking about how humans are going to be the ones, they're still making the trading decisions. There's a spoofing case where I think in the trial, they found out, they told the software engineer, I want to spoof, which was really good evidence for the prosecution. But eventually, to your point, you don't put handcuffs on a computer. There's a lot of hype, too much hype in a lot of places, but is there like anything under hype, do you think?
Yeah, I think that the speeds are a really good point to pick up on. And I'm going to use an analogy from the equity. And I can use this analogy because I was, at some point, a VWAP trader. I had to actually do VWAP manually because there weren't algorithms to do that. And there were a whole bunch of rules on the particular exchange that I was doing this on around how quickly you had to cancel an order if you were going to cancel that order. And they were basically based on the assumption that you could type 50 words a minute as a human because you're physically typing into a computer. And so that actual window of time to cancel an order persisted long after humans stopped typing in orders for volume-weighted average price ordering throughout the day. Now, of course, at 50 words a minute, my ability to cancel order in under 6 or 7 seconds, considered spoofing, etc. Over 6 or 7 seconds, that's just a human being a human. That's an eternity for a machine. And there are a whole class of those rules and regulations that have not been updated for a different paradigm and are very, if you can call it human technology based, are very technology specific. Spoofing is a classic example of that. Order to trade ratios are classic examples of that. And in equity markets, it became really obvious. It took a good 7 to 10 years for people to read that. I think there was a famous book that talked about flashing lights on exchanges and hide and light strategies, etc. And that was all around making the most of some of those rules and regulations that were built for humans executing orders, not machines, at a different speed and pace. The same thing has not yet been appreciated, I think, in the LLM world. And if we go back to my example of randomness distributions, what happens if a computer does discriminate? What do you do? And do you blame the programmer who actually didn't program in the distribution? So they didn't explicitly cause this? Do you blame the firm that released the technology? At some point, someone requires to be held liable. But how do you even tell that there's bias and it's not a good decision? Because there's not even really a lot of infrastructure around how you make LLMs justify their decision making. Ask an LLM how it made its decision. Ask that it's the same question to the same model 5 days in a row, you will get 5 different answers. This is not how models in finance are used to working. You ask the model the same question, you ask for the delta, you give it all the same parameters on any given day, and you're supposed to get, under a lot of regulatory requirements, by the way, the same numeric result. You do the same thing to an LLM, and you will get different results.
Gotcha. So the idea that you have a lot of this legacy 50 words per minute kind of scenarios, and that's just going to be exacerbated with speed. What's been the most surprising to you?
The humans. The humans are the most surprising. There is a pattern I've seen of humans not wanting to engage with technology and thinking that will just stop the technology. And that just does not work. That didn't work in the equity market. It hasn't worked in lots and lots of places. And I think it's also the idea, and maybe certain technology firms use this as part of their marketing plan, that this technology is so complicated, you can't possibly learn it. You can't possibly understand it. And actually, just like most of us probably don't know how our gearbox in our car works anymore, or how the anti-lock braking systems work, we all pretty much, those of us who drive, feel comfortable. We do know how a car works. And I really don't understand why people are scared of trying to get to grips with a working understanding of how some of these technologies that are in our lives or not, whether we realize it or not, how it actually works.
And you think that's just reluctance from folks, I've been in the industry for a long time, and they're just adverse?
Yeah, I think it is, definitely. I think also, this also goes to another deep passion of mine, which is maths education. And I think a lot of people, unfortunately, and it's really sad, and listeners out there who have this, please get over it. Maths is not that scary, and it's not intractable, and it's not impossible. And even if you didn't understand trig in high school, which is the most common thing I hear, all the maths comments I ever hear in my life, it's like, I never understood trig. I can write an entire blog post on people who don't understand trig, and yes, it really is possible. I think there is, I don't do maths. I don't understand this. Therefore, I can't understand it. Actually, can. Just like a car, we don't need to know how every component works to say, you know what? I know how my car works. It's okay.
It's okay. You can have the conceptual framework.
Exactly. Precisely. You can get a conceptual framework and feel confident in coming.
Is there anything else that we should have asked you?
No, thank you very much. I think this is a really interesting part of finance world that is getting more and more interest as the world goes on and is developing so rapidly. I really enjoyed our conversation today.
Thanks for joining us.